A rogue trader is a term for a financial trader authorized to make trades on behalf of their employer, who instead makes unauthorized trades. The key factor is the lack of authorization. There have been colossal financial losses and bankruptcies stemming from bad decisions made by senior decision makers in the financial industry, a good example being the bankruptcy of Lehman Brothers, but this isn't usually described as rogue trading, and it's not usually criminally punishable. The 1999 film Rogue Trader about derivatives broker Nick Leeson and his role in the 1995 collapse of Barings Bank brought the term into the mainstream. There's a long history, of course, of these incidents in the world of trading and finance, with many really colourful characters and crazy stories. I've tried to narrow it down to a list that includes both the biggest losses but also the craziest stories. There are some really crazy stories on the list, but if there are some great rogue trader stories that I should have included, do let me know in the comments section below. Okay, so coming in at number 10 is Nick Leeson. He's probably the best known rogue trader, notorious for bankrupting Barings Bank, the UK's oldest merchant bank. In 1992, Barings opened up in Singapore, appointing Leeson to head both front office and back office operations. Leeson had been denied a broker's license in the UK because of committing fraud on his application form. Neither Leeson nor Barings disclosed this when he applied for his license in Singapore. From the start, Leeson made occasional unauthorized speculative trades. He opened a false customer account that he claims was first used to hide an error made by one of his colleagues, who accidentally sold futures when she had been asked to buy them. Leeson had heard that the number 8 was considered lucky in Asia, so he gave this account the number 88888. It turned out, unfortunately, not to be a lucky number for Nick. Nick would book the trading errors to this account and then wait for them to move back in his favor. If the market moved against him, he would just double down, with the logic that the market now only had to retrace itself half as much in order for him to break even. By the end of his first year, the error account's losses exceeded £2 million, increasing to £23 million the next year and then ballooning to £208 million by the end of '94. In January 1995, the Kobe earthquake struck Japan early in the morning, sending Asian markets and Leeson's trading positions into a tailspin. He did what he usually did and bought more in desperation, but the market, of course, continued to fall. He bought, and whenever it lost money, he bought again, and finally he bought, but this time, instead of being more futures, it was a plane ticket to Germany. He left a post-it note on his desk that said, "I'm sorry." Leeson was arrested when his plane landed in Frankfurt, and after a failed bailout attempt, Barings was declared insolvent. Leeson pleaded guilty to 2 counts of deceiving the bank's auditors and of cheating the Singapore exchange, including forging documents. He was sentenced to 6.5 years in jail in Singapore and was released in 1999. He published an autobiography that was called Rogue Trader, which was later made into a film starring Ewan McGregor. In 2013, he appeared as a contestant in the Irish version of Celebrity Apprentice, a TV show best known for launching political careers, so who knows what is to come for him. When Leeson was hired, the management of Barings made him the general manager of the Singapore branch and the chief trader, while also being responsible for settling his own trades. Now, these jobs are usually held by different people, which would have made it much harder for Leeson to hide his losses from management in London. You'll start to see this sort of mistake from management throughout all of these stories. Okay, so coming in at number 9, we have Brian Hunter, a Canadian natural gas trader for the now closed Amaranth Advisors hedge fund. Amaranth had over $9 billion in assets under management, but it collapsed in 2006 after Hunter's gamble on natural gas futures went horribly wrong. Before working for Amaranth, Hunter had a volatile trading career. In 2003, while working for Deutsche Bank, he and his team lost $400 million in a single week in an excessively risky trade. In a New York State lawsuit, Hunter blamed Deutsche Bank's trading software for allowing him to take large gambles, and he claimed that he actually deserved a bonus. Instead, Deutsche Bank fired him. While at Amaranth, Hunter liked to trade bear calendar spreads in natural gas. He would go long March gas and short April gas, a position that would benefit from long cold winters, as storage facilities would have become depleted at the tail end of the winter season. It's kind of obvious, I guess, Canadians would naturally just have this urge to bet on long cold winters. In addition, Brian Hunter would short summer and fall gas contracts and go long winter contracts. Now, traders often vary their trading ideas and positions for a variety of market conditions, but amusingly, Hunter demonstrated a remarkable lack of creativity by putting the same positions on year after year in just larger and larger size. In August 2005, Hurricane Katrina hit New Orleans, damaging or destroying 30 oil platforms and causing the closure of 9 refineries. The bear calendar spreads became extremely profitable due to the supply chain disruption. Amaranth became one of the top performing hedge funds of 2005 due to this surprise event, which attracted in billions in additional capital. The very next year, Hunter was emboldened by his prior victory and of course put on the exact same trade but in even larger size. When the market took a sharp turn against this view, Amaranth failed to meet margin calls and was forced to liquidate their positions, crystallizing a $6.6 billion loss and a dissolution of the firm. The lesson here is that investors who pile into a fund after a big win should really have done a little bit more research and understood what caused that win the prior year. It was kind of a random event. And equally, they should have maybe looked into Hunter's history of very volatile and occasional big losses. In 2011, Hunter was fined $30 million for manipulation of natural gas prices. This fine was later thrown out after an appeal because it was the CFTC who had authority over derivatives rather than the agency that fined him. Next up at number 8, we have Robert Citron. Now, Citron was the elected treasurer and tax collector of Orange County, California, which declared bankruptcy in 1994, brought on by Citron's investment strategies. Citron's job was to send out municipal tax bills for the county and to then invest that money in interest-bearing securities in order to earn some interest on it before it was spent on things like road repairs, garbage collection, town employee salaries, and that sort of thing. It's not necessarily the most exciting job, but luckily Robert was able to make it a little bit more exciting. Robert used to borrow money to enhance the returns, leveraging the portfolio over 290%. He was apparently a colorful character who wore pastel polyester suits, oversized turquoise Native American jewelry, and he apparently adorned his desk with a bronzed lump of horse manure from Traveler, the University of Southern California mascot, a university that he had taken some classes at and failed all of them. He was known to be a bit of a buffoon, and the county officials apparently used to try and keep him out of sight. Citron became best friends with a Merrill Lynch salesman named Michael Stamenson, and he would basically just buy any product that Stamenson was selling. Stamenson had been in trouble before for mis-selling securities to the city of San Jose and also to West Virginia. Both cases were settled out of court, and in neither case did Merrill discipline Stamenson. Stamenson sold all sorts of complicated bonds to Citron, products like inverse floaters that would decline rapidly in value when interest rates went up, and things like trigger notes, which are a sort of a short-term bond whose maturity would extend if interest rates moved above an agreed interest rate on an agreed date. Evaluating these kind of, sort of financial derivatives, they're bonds, but they're kind of derivatives, would have been impossible for someone like Citron who didn't use a computer or a calculator, other than apparently he had one of those calculator watches that he would wear on his wrist so that he could divide restaurant bills down to the penny. Enormous fees were obviously tacked onto these structured notes. Orange County paid over $100 million in fees to Merrill Lynch, earning fat bonuses for Stamenson. In 1994, the Federal Reserve began to raise U.S. interest rates, causing many securities in Orange County's investment pools to fall in value. As a result, dealers were requesting extra margin payments from Orange County. These extra margin payments were funded in part by an additional $600 million bond issue issued by the Orange County. This fix was only temporary, though. In December 1994, Credit Suisse First Boston realized what was going on and blocked the rolling over of $1.25 billion in repos. At that point, Orange County had to file for bankruptcy. At his trial, Citron left his wild clothes at home. He wore a grey suit. He apologized and pleaded ignorance. He said, "In retrospect, I wish I had more education and training in complex government securities." He tried to excuse his whole life. He didn't serve in the military because he had asthma. He didn't graduate from USC because he had financial troubles. He was an inexperienced investor who never owned a share of stock. Now, Stamenson also testified, and he said he was sorry too, but he also pleaded ignorance, saying that Citron was in fact a highly sophisticated investor and that he had learned a lot from him. Orange County obviously went on to sue Merrill Lynch for $2 billion, and Merrill settled out of court for $470 million, including fines. The court sentencing inquiry revealed that Citron had the math skills of a 7th grader. Psychologists put his ability to think and reason in the lowest 5% of the population. A court-appointed psychologist told the judge, Bob Citron was like an empty bottle on the bottom of the ocean being pushed along by a wave. He was sentenced to 1 year of community service. According to the New York Times in 1998, Stamenson was still at Merrill Lynch. He was kept on as he was the man who knows too much. Because his actions and his close relationship to Citron were fully known to his bosses, it would be difficult for Merrill to contend that he was a rogue broker and to cut him loose. There are lots of lessons here. Firstly, don't invest in products that you don't understand. But also, if you work in finance, be careful when selling financial products, especially if they are complex. I don't know what eventually became of Stamenson, but Merrill paid out obviously much more in fines than Stamenson ever brought in profits. In addition, this will have tarnished the bank's image, costing them additional new business over the 4 years that this case worked its way through the courts and was in the newspapers. And one final lesson, which is possibly one of the greatest lessons, is just don't invest with a man if he has a bronzed horse manure, a lump of manure on his desk. It's never a good idea. It's not a good signal. Okay, so coming in at number 7, we have Joseph Jett. Now, Joseph Jett was nothing like Robert Citron. Jett was actually a very smart man. He had a degree in chemical engineering from MIT, and he was an MBA from Harvard Business School. Jett worked for a bank called Peabody, which was an investment bank that was owned at the time by General Electric. Jett's primary strategy, though, was just to exploit a flaw in Kidder's computer systems that made unprofitable trades appear profitable. In fact, it would appear that he never had any profitable trades. Kidder's system incorrectly valued forward-dated transactions as if they were immediately settled rather than taking into account the time value of money for the period before settlement of the trade. By buying US Treasury bond strips and hedging them with a short Treasury bond position, Jett was able to book immediate illusory profits. Once settlement of the trade happened, any false profits would immediately be reversed as a loss in the system. So in order to continue to appear profitable, Jett had to engage in more and more of these trades, enough to both offset the losses on the settling trades, plus additional trades to keep delivering these false profits. For the scheme to persist, the size had to continually grow, and this is what eventually brought the scheme's downfall about. Jett's trading size had become so large that General Electric, the owner of Kidder Peabody at the time, asked that he cut his position size because of the bloating of GE's balance sheet. With no new trades to offset those settling and rolling off, the losses became apparent to Kidder senior management. The SEC didn't actually initially find Jett guilty of securities fraud, and instead he was charged with record-keeping violations. They ordered him to forfeit his $8.2 million in bonuses, and they fined him $200,000 and barred him from the securities industry. Jett went ahead and appealed this decision, but so did the SEC. And this time, in addition to upholding his record-keeping violation, Jett was also convicted of securities fraud. Today, according to his website, Jett currently operates a firm called Jett Capital Management, LLC. Its website says that the firm offers asset management, advisory, and private equity services. It's not clear to me how he would be able to do any of these functions while being permanently barred from the securities industry. One of the big lessons here is that Jett was the most profitable trader at the bank, and management had no idea how he was generating any of these profits. Managers often want to pretend to be much more sophisticated and knowledgeable than their employees, and possibly then avoid asking these sort of basic questions such as, what are you doing and how are you making this money? But you really would expect senior management to make more effort to understand where money is being made in the business. At the time of this loss, it was the largest trading fraud in history. Next up at number 6, we have Jerome Kerviel. Back in 2008, when Jerome was all over the news for losing almost $6 billion, the press told us really two things about him. One, they said that he was a bit of a dull guy, and the other thing they said was that he looks like Tom Cruise. Now, he in no way looks like Tom Cruise, other than that they both have eyes, a nose, and a mouth. But other than that, that's where the resemblance stops. I also kind of wonder what you have to do in order to be considered exciting by these people. He bought $75 billion worth of Eurostoxx futures without authorization on his employer's account. And I just feel if nothing else, we have to classify that as being at least a little bit exciting. So Jerome joined the middle office of the bank Societe Generale in the summer of 2000, initially working in middle office dealing with trade settlements, essentially making sure that the various traders at the bank had booked all of their trades correctly into the computer systems, which would then feed into accounting and risk management systems within the organization. In 2005, he was promoted to the bank's Delta One products team in Paris, where he was a junior trader. And this would in truth be one of the duller trading jobs out there. It's basically an order entry functionary role on the trading desk. His job would be to arbitrage price differences between identical stock market indexes, basically trading futures against forwards and that sort of thing. He began his unauthorized trading in 2006, initially on a small scale, eventually putting on a trade larger than the market cap of the bank that he worked for. Because of his background in middle office, he knew how to hide these trades from his bosses. They still should have noticed, because much like with Nick Leeson, there would have been this need for huge margins to be posted to the exchanges. When his bosses did discover the huge position on, I think it was January 21st, 2008, it was Martin Luther King Day in the United States, which meant that the markets in the US were closed. And so it would have been expected to be a very quiet day in the markets. So what happened was a trader at SocGen was put in an office away from the trading floor and told to liquidate this huge position. He wasn't told that it was the bank's position, and he had his cell phone and taken away from him, and he wasn't allowed to send any emails or anything like that. He just had to spend the day selling this huge amount of Euro Stoxx futures into a very illiquid market. Now, as I said, it was a particularly bad day to be doing this with the US markets closed and so many traders away from their desks. So there was no one really there to absorb this selling pressure. And the selling pressure caused global markets to fall violently. The FTSE had its biggest ever one-day points fall. European stocks closed with their worst results since 9/11, and Asian stocks dropped as much as 15%. The S&P 500 futures, which were open as sort of an overnight market, went limit down, and the Fed chairman Ben Bernanke, seeing this, held an emergency meeting of the Open Market Committee and announced a 0.75 percentage point interest rate cut that day. The French press at the time came out with all these stories claiming that Kerviel was not to blame, that he was pushed to put on these huge trades by his bosses. And the argument is just, it's utterly ridiculous, because there's just no way that any sort of junior trader like Jerome would be given a job to put on a bet bigger than the market cap of the bank. Like, I can't picture it, the senior traders all standing around and saying, we want to make this huge bet on the Euro Stoxx futures. Well, who should we have do it? The guy who looks like the Tom Cruise. Didn't happen. In a rather breathtaking understatement, one of Kerviel's bosses at SocGen referred to him as not one of our stars. In 2010, Jerome was found guilty and sentenced to 5 years in prison with 2 years suspended, and he has to pay back the 5 billion euros that he lost. Now, I don't know how that's coming along for him. In addition, he received a permanent ban from working in the financial services industry. Now, in 2016, Kerviel managed to win an unfair dismissal case against SocGen, which is, I guess, French law. It's kind of amazing to me that he's somehow expected to be kept on at the bank as someone who is banned from the securities industry. But maybe they could just give him a different role. Coming in at number 5, we have Kweku Adoboli, and in truth his story is almost identical to that of Jerome Kerviel. So he started out in back office at UBS in 2006, and after 2 years he was promoted to the Delta One trading desk, just like Jerome. Beginning in 2008, Adoboli started using the bank's money for unauthorized trades. He entered false information once again into UBS's computers to hide what he was doing. Interestingly enough, Kweku also traded alongside using his own savings in 2 spread betting accounts where he managed to lose around $150,000, but at least he was on side for the bank's trades. He was caught in 2011 after losing around $2 billion for UBS. The trading losses that he incurred were the largest unauthorized trading losses in British history. He spent around 3.5 years in prison and was then deported from the UK upon release. The surprising thing about this loss was just how similar it was to the Jerome Kerviel incident, and the fact that UBS didn't have any better systems in place after seeing this happen at SocGen 3 years earlier. Now, historically, a lot of traders actually got their start by working their way up from these support roles at investment banks. Unfortunately, for a lot of younger people, this pathway into the world of trading got shut down because of people like Jerome and Kweku. Banks now view it as maybe too risky to have someone working as a trader who has previously worked in a support role and might know how to hide losses in the systems. Okay, so next up at number 4, we have Elizabeth Young, who worked for a firm called Morgan Grenfell in London, managing the £1.2 billion European Growth Fund. In 1996, Young was named Investment Manager of the Year, and then a year later in 1997, it was discovered that Young, who was a man at the time named Peter, stole around $600 million from the firm by, amongst other things, investing in companies that he himself owned. Young used an elaborate network of Luxembourg companies to disguise the nature of many of his investments, but he was caught making reference to their true purpose on routinely recorded telephone calls from his office. In 1998, Young, who was now answering to the name Elizabeth, appeared in court as a woman and was charged with various counts, including conspiracy to defraud, but his lawyers said that he was too ill to face a legal battle. The Serious Fraud Office disagreed and a jury was asked to decide on Young's fitness for trial. Hearing graphic evidence of repeated attempts at self-castration, it was decided that Young was in no position to mount a defense, despite revealing no mental health problems before the fraud was discovered. In 2003, Young was found by a jury to have orchestrated a complex fraud on the fund investors, but did not face jail time because of her mental state. Okay, so coming in at number 3, we have Bruno Iksil, the London whale. Now, it's worth noting that there were actually 2 London whales, and this causes a lot of confusion. One was a northern bottlenose whale, which was discovered swimming in the River Thames back in central London in 2006. And the other was Bruno Iksil, who was a French derivatives trader, and he was not an actual whale. We have to be clear about that. Now, Bruno Iksil achieved notoriety with one of the worst trades in history. He lost $6.2 billion placing risky bets using credit derivatives while working for JP Chase. In a sense, what Iksil did was the same old story, doubling down after a loss with bigger and bigger bets. But plenty more was also wrong. Iksil worked in a part of the bank that was called the Chief Investment Office, and the main role of the Chief Investment Office at JP Morgan was to hedge or reduce the bank's risk level. Instead, they decided to take risk in order to become a profit center for the bank. Iksil's team focused on complex derivatives trades that had less and less to do with hedging over time. As the strategy unraveled, Iksil's positions grew so big that they disrupted the thinly traded markets that he worked in, earning him the nickname of the London Whale. But he's not an actual whale, and making his groups hard to unwind trades a target for hedge funds. After the trades collapsed, regulators found that Iksil's colleagues had been keeping 2 sets of books to minimize the projected size of the losses, a discovery that triggered investigations in the US and the UK. Prosecutors said that the team committed securities fraud by hiding the true extent of losses from bank management. Okay, so we're down to number 2, where we have Stephen Perkins, who was an employee of PVM Oil Futures, and this is a bit of a working from home cautionary tale. So Stephen worked as a Brent crude broker out of PVM's London office. Now, his role was to trade in futures for clients. He was not allowed to do any trading using PVM's own money. On the 29th of June 2009, after spending a weekend drinking heavily, Perkins returned to London from a company-sponsored golf weekend and continued drinking all day. When he arrived home, he made some trades, which he said were for a client. According to Perkins, later that day, he suffered an alcohol-induced blackout. Beginning at 1:22 in the morning, while still blacked out, Perkins traded 7 million barrels of oil worth around $500 million. At this hour in the morning, this represented 69% of the volume of oil being traded at that time, and it was 10 times the average trade volume. He made his last trade at around 3:41 in the morning, approximately 2.5 hours later. Perkins then sent a text message to his boss at 6:30 a.m. stating that he was feeling ill. He was later contacted at 7:45 a.m. by an administrative clerk at PVM inquiring about the early morning trading activity. Perkins replied that he had spent the night assisting a client with trading. However, by around 10 o'clock, his claim had been disproved and PVM attempted to rid themselves of the futures contracts. The price of oil worldwide rose by about $1.50 per barrel due to his trades, the highest price in 8 months, before reversing sharply. A move like this might generally only be caused by major events with geopolitical significance. After an investigation by the FSA which deemed him not fit and proper, Perkins was barred from working as a trader for a minimum of 5 years and fined a total of £72,000. The number was reduced from £150,000 after Perkins expressed concern that the fine would cause him undue financial hardship. When delivering the report, a regulator for the FSA said that Mr. Perkins poses an extreme risk to the market when drunk. Okay, so coming in at number 1, we have the invisible man, Liu Qibing. Qibing was a copper futures trader at the London Metals Exchange, working for China's State Reserve Bureau, a central government body that stockpiles commodities for the country's industries. In early 2005, Qibing was convinced that China would tighten monetary policy by raising interest rates in an effort to cool the economy and dampen inflation. This would normally cause copper prices to fall, since China would stop buying so much. Liu began shorting copper or selling some of it with the intent of buying it back later when the price dropped. When prices went up instead of down, Qibing started doubling down in order to improve his average cost. But this strategy only resulted in bigger and bigger trading losses. Sometime in early November 2005, faced with hopelessly large losses, Qibing vanished. By mid-November, stories emerged on London trading desks that a Chinese trader had built a huge short position in copper and then disappeared. The rumors drove up the copper price on the futures market, with traders betting that eventually China would have to buy copper back in order to cover this short position. The Chinese State Reserve Bureau initially denied Mr. Liu's existence, despite LME traders saying that they knew him as China's main copper trader. Eventually, the SRB did take ownership of Liu's trades and tried to manage the loss they incurred rather than immediately close out the trades. Copper prices continued to rise, and it's estimated that in the end the total loss came to around $1.2 billion. One of the striking things about rogue traders is that they seem to always lose money. Perhaps they're just born with an incredible knack for being wrong about future market direction, or perhaps if they guess right, they aren't exposed by their employers as rogues. What lessons can we learn from these stories? Well, firstly, we can see how important it is to supervise employees and have proper controls in place at financial firms. In addition, we can learn not to confuse luck with skill. We also learn that it often makes sense to take a small loss early on, and that you should only increase your position size if the market opportunity has also improved, not just in response to losses. Finally, we learn that if disgraced, you can always make a comeback as a motivational speaker, except of course if you lost money for the Chinese government. If you enjoyed this video, you might also enjoy my top 10 craziest Ponzi schemes video, which I'll link to in the description below. Don't forget to hit the like button and subscribe if you'd like to see more content like this. See you later. Bye.